Hello, good afternoon. It's an investment show, Modern Investing. My name is Sasha Star, and I would like to introduce Nick Poliveda, founder of the Pod TV, formerly IBM TV. Nick Poliveda.
I'm here.
Hello, how are you, Nick?
Hello. Rosadania.
So today, for the first time, we are trying somewhat a new formula. We will have four segments, and we will start with the first one, which is high-paying dividend stocks. So this is supposedly, I hope, a core of any investment portfolio. Why they're so important? First of all, they are very stable. As a rule, they're very stable stocks. And if you know the rule of investments, preservation of capital, and there is another rule which was proposed probably more than 20 years ago by William O'Neill, at that time publisher of Investment Business Daily, highly respected investment professional. He suggested one of his rules was that whenever you have loss of 7% on any single stock position, terminate the trade, take your loss, and look into something else. Just a rule without thinking. So, however, that rule I found is not fully applicable to high-paying dividend stocks. I'll tell you why. Hello, Peter. How are you today?
Okay, it was a little glitch for a second. Okay.
You're just
No
having some
problem.
feedback
We,
on your computer. That's all.
we are talking about now high-paying dividend stocks. So, why I believe that this rule is not fully applicable to high-paying dividend stocks, taking loss one stock moves down 7% from your initial purchase. Because let's say a stock is paying 7% dividend, and it moved down on you 7% from your purchase price. So by recovering 7% in dividends, in fact, you're still in a neutral position. You're still not losing any money. And second year, hopefully you will collect, I'm talking about dividend stocks with a stable, proven dividends. So second year, you will collect another 7%. And even if the stock will stay the same and it will not move higher or lower from this position, you will be still in a winning situation. In fact, if stock will move even down another 7%, you're still not losing because of the dividends. So they're very stable stocks. I believe they should be core of any investments portfolio. And I hope three of us follow this rule. I hope, and now I would like to, Peter, share your experience with high-paying dividend stocks.
Yeah, I have some interesting evidence, but I'm not aware if there's a tax change that is affecting dividend stocks. Is that what you're saying, Sasha, or no?
No. What I'm proposing is that let's say stocks are paying 7% dividend, and there is a rule of one of his rules of William O'Neill, the publisher of Investment Business Daily, highly respected investment professional, is that control your losses. And if any given stock moves down 7%, you're still doing fine because you collect 7% dividend of that stock.
Yeah, no, there's no doubt about it. I have some interesting things I've been meaning to say anyway about it. But first of all, every study I've ever seen shows dividend stocks outperforming non-dividend stocks. And sometimes, depending on the time frame, like I saw one study, maybe it was 20 years, and it was like 12.5% average appreciation for non-dividend stocks and about 13.5 or so for dividend stocks. So, but then I saw recently a study from 1973 to 2020, And this is, so it's a very long-term study, and it was amazing the difference in terms of performance. So listen to this. If you had $100 put into non-dividend payers in 1973, you only earned 21.89, which seems like a lot. That's still 20 times, right? But if you did the S&P index, you would have done better because there's some dividend payers in there. It would have been worth 37.64. If you had dividend payers, it would have been 69.46, which is like 3 times the non-dividend payers and about twice the S&P. And listen to this, if you had dividend growth stocks that have been growing consistently their dividends, which is what I love. I mean, that's because then you're getting the best of both worlds. Is you're getting appreciation and you're getting increased dividends over time. It would have grown to 11,376. So it basically, the dividends growers grew more than 5 times faster than the non-payers and 4 times faster than the S&P as a whole. So that tells you everything there. And I'll let you guys talk about it. But then I have one other point too.
Okay, what's your experience with high-paying dividend stocks?
Can't hear you, Nick.
I gotta turn my microphone on. Okay, so in the pension funds that we manage or advise on, which is about $500 million, which is a small administration company, the our requirements on a pension, you have to earn a range of 4 to 6% like every year, and it's very difficult to do. You can put money into annuity contracts that actually perform right now at a 1% to 4% level. And literally, Sasha, to do better than that 4% is next to, or let's put it this way, to get a contract that gives you better than 4%, we can't find it. It doesn't exist. To get a CD that's better than 4%, can't find it. It doesn't exist, which means if you're going to do better than that, you're going to have to take some risk in the equity markets. Unfortunately, we're always, because of the nature of the laws, we're always forced into these annuity contracts that just don't pay very much. So here's the way I look at it, working with retirees and pension funds. If you said, hey, Nick, I got the stock, it's not going to go anywhere, but you're going to get 8% per year based on the current value of your investment. Because notice, if you get 7% of a lesser amount, it's not good. But usually if the stock goes down, the dividend is really 10% because it's always based on that fixed amount. So the thing is, if you said, hey, I'll give you 8% a year, forever, I'll sit there and I'll call up my $500 million worth of people and say, look, I got Sasha. He's going to guarantee 8% forever, or 6%, or frankly, even 4%. Now, a lot of people listening think 4%, well, I do better than that. All is time out. 4% forever. Okay, you don't. And see what's happened, Sasha, we're all in this illusion because the market has continually gone up since 2008. No one here, a lot of people here have never suffered what happened in 2008, where the market went straight down. And people were crying all over the country, even my office. I had a 10,000 square foot office. After by 2010, it became a 1,600 square foot office. I mean, I had to continually renegotiate my lease. Yeah, 10,000 square feet. Peter, it was pretty big. I had the whole 4th floor, had 34 offices. Well, that was in 2008 when things were going well. Then all of a sudden it became 5,000, 3,000, 1,600. I mean, we continually had to scale down because not only did it hit in 2008, it didn't go away. 2009, 2010. I mean, but that
was the mortgage. Just to be clear for the viewers, that was the mortgage crisis.
Yes.
That triggered that, and that's a whole nother discussion. What caused that? There's debate there.
Yeah. So you went through downsizing process.
Oh yeah. I downsized a lot of the company back then because there wasn't anything else to do. And some of the employees go, "Why do you have to lose the job?" I said, "It's because no new business is coming in. All we're doing is we're working on the old business that's been on the books."
I would call it forced downsizing, right?
Yeah, it was kind of a forced downsizing. But see, the thing is, Sasha, a lot of the investors today that are in the market haven't gone through the cycles. They've never seen a down cycle. They've never got punched in the gut. It's like Mike Tyson says, everybody has a plan until they get punched in the gut or hit in the face. Then all of a sudden,
that's good. Yeah, you're right.
Right. So what happens is a lot of the people listening they're all seeing this up market. They've never seen a down market, so they don't know what happens. But I can tell you what happened. Now, by the way, in our pension funds, we were on guaranteed accounts. We earned 4.5% that year, and we didn't lose anything in the pension funds. But that's the nature of how we had to invest the pensions. In the 401k plans, they became 201k, Sasha. People lost basically half the value of their accounts overnight. It was like all of a sudden, when am I going to retire? So I think investors don't see this now. But here's why I see the dividend stocks. You're right, if you can get that return, even if the stock goes down, but you get that return coming in every year, you should be good to go. So you have a lot of room with a dividend stock to absorb losses, which you really just don't have in the momentum stocks like AMC, Tesla.
Oh, meme stocks. Yeah, exactly.
Okay, I mean those things. The momentum.
Well,
the momentum is any day, anywhere, right?
Hey, look,
stop swearing, because we're talking about high-paying dividend stocks.
Oh yeah, high-paying dividends.
When you're talking about GameStop and AMC,
right.
There is no high dividends. There is no
I don't know
if
I told Peter I bought AM Holdings. I thought it was a good deal. It went up, and so I'm very happy with that.
Are you talking about AM Midstream?
AM Midstream, yeah, I bought that.
The energy stocks have been tremendous. TRPs have been tremendous.
Yeah, and earlier in the week,
USAC is at 16, MPLX is at 31
I know.
and something.
All my portfolio's up, and everybody feels brilliant about it. But come on, you have to look at what you did relative to the S&P 500.
Right.
And then I also have money that's professionally managed. And my professional money manager, I haven't got the report this week, was 8.5%, 8.8%, almost 9. I'm sitting at 15, and the S&P is 11. Go figure. Okay.
That's solid.
But the thing is, I don't think I've taken any more additional risk. I did add Apple to my portfolio. I thought I'd never buy that, but it was under 100. It was under 130 a share.
We can discuss that later.
Hey, it paid a dividend. It pays a dividend. It's a tiny dividend.
Well, you know what? I just read an article today that, for what it's worth, it's not a terrible stock, but among tech, I don't like it at all. First of all, they've only increased their income 1% a year for growth stocks. Yeah. And they've got a lot of competition now from Microsoft and other companies. Sure. And anyway, this article said it was 68% overvalued. I'm not saying it's true.
Okay, but see, here was another article that said that they have more free cash flow than Apple. Apple has more free cash flow than Google or Amazon.
Unless there's price competition, their margins go woo. Yeah, you can't sell thousands.
Yeah, I know. I mean, but the thing is, I bought IBM months ago when I look at the price, and the price looks good. I bought IBM when it was like $130. Now it's 150. Okay, so I'm going, okay, I've done well on IBM, but I bought it because I had a dividend. Apple, I'm totally with you. I was very reluctant, but I'm going, hey, look, it was under 130, and when I bought it last time, it was like 100 a share. Something like that.
I would like Apple if I had no other choices, but to me, among tech, we'll talk about this under the options.
It really depends. It really
compare
depends.
Compare that to an Amazon or a Microsoft or an Nvidia. These are companies that have huge futures, huge growth, and still similar.
Yeah, but they also have huge breakup value, which is, I mean, one thing I must give credit. I guess it was in one of the newspapers I read today that Amazon buys Washington D.C. 250 people that worked for government now work for Amazon. Not lobbyists. They just, Peter, if you worked for the White House and you just lost your job or you quit, Amazon's there offering you a job.
Sure.
You will go to great.
And they just put their second headquarters in Virginia, very close to Washington, which is not a coincidence.
Not a coincidence. They have 250 government employees working for Amazon.
On the other side, the government is now putting a lot of pressure on all these companies to, in all kind of ways, saying, there's 5 different bills going through this week that they're discussing where they might say, okay, you can't buy any new companies. You can't, or we'll maybe break you up or whatever. You can't have certain products. It's going to hurt some of these tech companies. Some have heard more than others, but I've heard, I think Amazon will get through it fine. Microsoft already went through antitrust, and Nvidia, I don't think they'll have an issue. If anything, they're going to get a big payment from encouraging production of chips in the U.S. Maybe that'll help them with all that money. But
and don't forget coming stock split on Nvidia in July.
There's a stock split on Nvidia in July.
4 for 1.
4 to 1.
You're kidding.
No, that's been announced for a few
Okay.
weeks now. I loved it. I mean, I was in there before. You know what? Let me throw another concept out, which is one you hear in MBA school a bit, and also you hear about it in investment, which is, and it relates to dividend stocks, but it's called duration. And a lot of people maybe never heard of that. Many people, it may be simple to them, but it's used in bonds all the time, bond investing. And duration means basically how long does it take to get your money back? In
To
other words,
maturity.
and it counts the interest flows and it counts the principal. So let's say, I'm going to give an easy example. You have $1,000 bond and it's in 10 years and you get, 1% back. It doesn't take 10 years to get your money back because on average, you're getting that 1%. So maybe your duration there is 9.5%, 9.5 years. But if you're getting higher dividends, then your duration goes, at least you have a duration. Let's say you put your money in a stock that has 0 dividends. Then if the stock doesn't do great, but keeps paying the dividend, it doesn't pay any dividend, I'm sorry, then there's no duration, basically. There's no guarantee you get your money back. It could keep going down forever or maybe stay flat forever until you sell it, you don't get your money back. But let's say you have a dividend stock. Well, not only do you have your investment whenever you want to sell it, but you have a duration because at least let's say you're getting 4%, and because I like a lot of stocks that pay 8 and 10 and others that pay 2 or 3 but are going to grow their dividends. So let's say you're getting 5%, 4%. At least in 20 years you're getting your money back, even if you just hold on to the stock. So that's a way to limit risk, and it also limit if there's a big downturn.
It's a very good point. Now, I would like to
need income desperately.
I would like to conclude this part of the show and start the next one.
Can we take our commercial break now?
Yes, of course.
We'll do that. We'll be right back.
Okay.
Hi, it's Sveta and Ben, the world's #1 impact investing experts. I have been educating thousands of people on the topic, how can you use finance as a force for good?
And I have been helping hundreds of entrepreneurs all around the world to set up, run, and establish their companies and businesses.
Do you even know what is impact investing and how can you get engaged in that?
Did you know that in the coming years, we are going to lose 26 trillion of our GDP due to the climate change? But on the other hand, are you also aware of all the opportunities that the sector has to offer?
Are you aware of changing policies and businesses which already impact every little part of your life?
To have the answer to all these questions, come and join us at Swiss Impact with Banerjees on every Friday afternoon 3 o'clock Swiss time, starting from 15 January.
We will be interviewing thought leaders, world leaders, policymakers, investors, businesses, which are already engaged in this sector. So see you on Friday.
See you on Friday.
It worked.
Wonderful. Okay, let's move to our second part of the show, which is gold, silver, which some people consider as a poor man's gold, and Bitcoin and cryptocurrencies. Actually, I have one stock which belongs both to dividends and also gold stocks. It's one of my favorites personally. It's a Barrick Gold, and it pays almost 4% dividend, and yet it's pure gold play as you can compare it to almost none other gold companies because it has enormous proven reserves. They're looking for new acquisitions to grow their proven reserves, and with this dividend, it's not that easily dismissed, especially thinking that gold prices may move somewhat higher. Some people believe that gold will go easily to $3,000 per ounce. Some people believe that only to $2,500, but either as a result will be really good for Barrick Gold. And Peter, I would like to ask you what you think about the gold situation and some of other stocks rather than Barrick, or Barrick for that matter.
Sure. Well, first of all, I've now increased my allocation to gold to about 4% through GLD. which is pure gold. I like the gold stocks, but also they can be cyclical due to other things. And so I just want to own the gold as an insurance. And then I have about 1% in silver also. So I'm about 5% now in commodities, which is a lot for me in terms of these metals. But here's the thing. This is the way I view it. First of all, everybody views gold as an inflation play, but I view it as a relative value play. And what that means is if interest rates are really low, which I think very likely, and that's, I can get into that, but basically I think interest rates are heading towards zero in the United States like the most rest of the world in the next 5 or 8 years. So gold will hold its value against the small inflation we'll have. So it'll be, I predict, most likely small inflation, but much more than you can get in anything else. So the gold will keep appreciating. So, and if there's massive inflation, gold will probably do extremely well too, because you need a hedge, because the governments of the world, to sum this up, first of all, are going to be spending huge amounts of money. I mean, even if they didn't spend anything on Medicare, Medicaid, and healthcare in different countries for their over 65 populations, they've already got huge deficits. The United States has never once paid down the debt. In other words, we've had places where they advertise, oh, look, under Bill Clinton, the budget was balanced, but that didn't pay any debt down. Mm-hmm. And the debt keeps accumulating. Now it's 27 trillion. 2 or 3 years ago, it was 17 trillion. But it's so even that alone compounding. As a matter of fact, the current debt, if they increase this current debt in the United States by 3%, the interest rates on that by 3%, it would be more than our defense spending alone already. And it's growing and growing and growing. But there's also a huge unfunded liability around the world for Medicare, Medicaid, and everything. So these governments are going to want to keep rates at zero because they don't want to pay interest at all on this money. So very likely, unless they lose control of it, which is why gold is perfect, because it works in either case. But if they lose control, then that's it. But it's 80% they're going to use what's called yield curve control, meaning basically they're going to buy every bond over a certain interest rate. And so I like gold and silver as a hedge. It doesn't do anything for you, really. It doesn't make you money, but it's good as part of a balanced portfolio.
Actually, in one scenario, it's a fantastic asset. If you can imagine that there could be negative interest rates, so then gold will perform even better. So we have 3 scenarios: very unlikely negative interest rates, very low next to zero interest rates, and somewhat higher interest rates. And it seems to me in all scenarios are benefiting gold, in my opinion. Nick, what do you think?
Well, the thing is, gold is used a lot in India for religious ceremonies. It's used also as a metal in a lot of different forms and fashion. So it actually has some utility. The problem I always had with precious metals in general is where's the demand for it? In other words, how do you sell it? Why would people acquire it? But it's used it's ceremonial all the time. So it's actually, when it's produced, it actually is consumed. So it does have
also China and Southeast Asia. It's about
they produce and consume it. So with that and inflation, which I think we're gonna have a real inflation problem. I think, and gold also. I'm looking at the value right now of Barrick, the one we were talking about, looks to be a value play. I mean, one time not too long ago it was trading at 29 a share. Now it's down to 22. So it has some upside potential, I would say, to go ahead and buy it. And also, I believe that you're going to see a lot of inflation. And with inflation, there's items like gold, they're just going to go up in value. And the minute there's a scare, when people get scared, gold goes up. And I think we're going to, it really depends if your friend Biden signs a $6 trillion check. If he decides he's going to spend $6 trillion that we don't have, gold is going to go up like a rocket. If
we're already spending so much we don't have anyway.
I know that. Well, again,
the U.S. alone could have $200 trillion in medical liabilities, although I have an interesting point about that might reduce it a little. But the other countries too, everybody's going to give, take care of their over 65 populations around the world for medical care, long-term care. You know what? I did my insurance test because I'm a part-time health insurance agent, and they said the statistics on long-term care are amazing, but they said something like 70% will use at least some long-term care, but 20% are going to need long-term care on a long-term basis, meaning over 5 years.
Yeah.
And you know what? That costs about $100,000 a year in the United States. It's very expensive around the world. So when you consider medical care, long-term care, Medicaid, and Social Security deficits, it's probably going to add a lot to those deficits that countries already have and around the world.
Well,
So that's
the problem I have with gold is, will it outperform the market? In other words,
it's insurance.
Yeah, that's what I'm saying. It's more of a hedge.
You know what? It could.
Yeah.
I don't worry about it because, again, I own, by the way, the silver and a put. I just sold the long-term put and I bought it for free, basically. You know, and I get to keep the cash. You know, because I sold the 2023 put at 54. But basically, look, we're heading for tough times, and first of all, there's this medical crisis, but let me use this as why I think inflation is going to be really low. Even though the market thinks it's high, the market right now is wrestling with this. It's because, you know what, in the next 6 months to a year, 2 years, we're going to see energy inflation. That's another whole theory of mine, but I think the energy companies are like, you hate us. We're not going to invest a lot in new oil and energy resources, you know, and plus Biden's policies aren't pro-energy. So just like the tech got involved in the last election, energy may be getting indirectly, not intentionally, or maybe even intentionally, who knows, or just thought process. They might be thinking, you know what, let's let oil go to $4 or $5 for the next 2 elections and see how people like it. And just like tech put their thumb on the last election, and in so many ways, and the oil may be just saying, you know what, we don't like these policies. We don't like being attacked, you know, and maybe we just won't invest as much, means shortages of oil. So that'll put pressure on the inflation, but in the long run, here's the interesting things. And I got some new news about this. Two interesting points. One, so my theory is demographics, one, is going to drive inflation down. As people get older, they're going to have less savings. They're going to be spending their money. They're going to want to be tighter on their budgets. A lot of people, 2/3 of people in the United States take retirement at age 62, and they think, okay, I'm going to live for the next 30 years, you know, on that money. But any inflation at all is going to eat into it, and there's going to be medical inflation. There's going to be some cost, so that's going to eat into it. But here's the interesting. So that alone, the second thing that is going to really cause deflation is tech, in 2 different ways. One, information. So it's really hard to raise your prices when somebody can look on Google or Amazon and say, oh, wait, I can get this for 20 cents less. You know, it makes for a very competitive price environment. You can't really go, you know, raise much. You know, it pushes a lot of pressure on the providers. But now I'll get into the most interesting thing of the week. So robots. You know, robots are going to be very deflationary because they're efficient. So not only do you have the Zoom type things where you can save costs by not having as much office space, you have robots. So this week I saw Amazon, just this last week, 3 things. McDonald's says they're testing automated voices on drive-through. So you may drive through a McDonald's to order your hamburgers, and it's going to be a machine taking the orders. They're testing that.
Right.
Amazon is putting robots in their warehouses.
That's correct, right.
And they have robots that are I saw them, they have 3 different types of robots. One of them loads and unloads the boxes. Another one then brings it over. We've already discussed the restaurants where they have order takers. But here's what I saw today. I was going to talk about this anyway. This is the New York Post today. Rise of the machines.
Mm-hmm.
And if you look at this, first of all, you have an automated maitre d'. You have the bellhop bot at hotels. They'll take your bags. You have the clockwork manicurist. This is a machine that does manicures. Oops, those jobs are gone. We already know EVs, once they have driverless vehicles, that's 9% of drivers in the United States, drivers all around the world. And most importantly, worth seeing again, this is Nurse Grace. You ready for this? Nurse Grace is from Hanson Robotics.
Yeah,
It's out in the next 2 years, 2 years maybe. It says, Nurse Grace can entertain and help guide exercise. It can do talk therapy, leading take bio readings and help healthcare providers assess a patient's health and deliver treatments. That might help on the good side with keeping medical care costs down, because now you can, but obviously less staff. But
Peter, and
what does it do to the economy?
one good thing is that robots never ask for pay raise.
Right.
That's true. That's the reason they're such an
Now,
advantage.
what I'd like to point before we will go to the next segment, I would like to point out something. If our inflationary scenarios are right, and for example, gold in many scenarios will go higher in price, so Peter, do you think Bitcoin and cryptocurrencies will do the same thing?
You know, I always say this first. Bitcoin could go to $1 million or zero, but now I think Bitcoin is probably going to zero. And first of all, because Bitcoin particularly uses 0.6% of all the world's energy itself. One Bitcoin transaction mining is equivalent to 473,000 Visa transactions, 1 to 473,000. It's hugely energy efficient. Musk came out this week and said, maybe we'll accept it again if they make it energy efficient, but it's not energy efficient. And I don't know why Musk is involved in this at all, because he just throws stuff out. But here's the other thing. 85% of central banks are in the process of investigating digital currencies, issuing their own. And also in July, the United States is coming out with a report about what they're going to do about it. If I'm a government, I do not want somebody printing money, which is basically what this is. And anybody can get in the market. Okay, let's create a Sasha coin and a Nick coin, and
I think it's a great idea, Sasha coin.
Sure. Yeah, we'll start $1 million a coin, but it's all like Ponzi. It's all just driven by demand. It's pure speculation. In the end, I wouldn't put any money in it. That's for sure an understatement.
Right. Okay, Nick, are we ready for the next?
We'll take a commercial break and we'll be right back.
Okay, excellent.
Welcome. Today we're going to look at a unique tax planning opportunity using life insurance to create huge tax deductions for 2020. So listen up to this not well-known plan called 412E3. Today I have a very special guest, Max Culiet, who's a certified financial planner and a registered investment advisor to help us with understanding 412E3 plans. Max, welcome to the show. What is a 412E3 plan?
Well, thanks, Nick. Simply put, a 412E3 plan is a pension plan that has to be funded solely with qualifying insurance, life insurance, and annuity contracts. The contributions to the plan are fully deductible from federal income tax, state income tax, so most of the time Social Security tax and Obamacare taxes as well.
Well, Max, I have a client right now. He's facing a $100,000 tax bill, $100,000 in 2020. Is there anything that you can do for him today?
Sure, Nick. The Secure Act that was passed a while back allows us to set up a plan in 2021 to deal with the tax year 2020. And in many cases, you can deduct 100,000, 200,000, 300,000, perhaps even more based on an actual calculation.
Max, I hear you right. You said you can deduct $100,000. I thought you were limited to $19,500 in 2020. How did you get to a $100,000 deduction?
It's pretty simple, Nick. The $19,500 is a 401k limitation. Every plan has its rules. Profit sharing plans have a limitation of $57,000, but a pension plan is actuarially determined, and it can be well over $300,000 depending upon the math and the circumstances.
Well, Max, I want to learn more about this plan. How can I find out if this works for my clients?
Well, the best way is to give us a call. My number is 877-252-1692, or send me an email. We can certainly set up a go-to meeting, and then we can talk about your client, the specifics, the needs, etc., and design a plan that fits their needs and their budget.
Good
What I
presentation.
really do for a living is very boring, by the way.
Yeah. Okay, now we would like to move to a next segment. We are talking about preservation of capital through a prudent use of options. I think options is very little explored for majority of investors, and especially young people who are buying meme stocks like GameStop and AMC and others. They probably should be aware of the strategy, which is probably not as exciting as a GameStop that can gain 50% in one day. However, the prudent use of options can generate quite significant profits. And I would like to start with a simple strategy. We will go to more complicated later, but the simple strategy is a covered call. I think this has been proven winner. Speaking about options, actually, another popular strategy is selling put. In the whole history of options, starting in 1973 until today, the sellers of options beat buyers every year except 1987. There was a stock market crash. So generally speaking, sellers of options have an edge, and this edge consists of a time premium that sellers are essentially selling to buyers of options. So if you're selling, in my cases, I'm selling a lot of long-term options, and at the beginning, normally they don't really move for quite a lot. They're quite stable, but once time is getting closer to expiration, then you can see how your account really starts to grow. The only thing you have to do, you have to have a lot of pension, and you have to have a predetermined outlook that this is a winning strategy. Most of the cases, even if some position will move away from you, in a time given, it will return most likely to your winning situation. Peter, how about you? Are you using this strategy, a covered call?
I don't use the covered calls. What I do is I do protect myself with options. So what I do is I do this on my growth stocks. So my favorite three, NVIDIA, Amazon, and Microsoft. It was Google too, but I'm out of there now for now. I think it's still undervalued, but not as much as the other three. So what I do is I go very long, first of all, because then I collect a lot of premium, and it's like buying the stock at a much lower price. So as an example, if I buy 40, if I sell a put at 4,500, what I do is I sell the high put for long. So in other words, I'll sell a Amazon 4,500 put for 2023, and I'll get about, I'm just making up numbers now, maybe I got $1,400. So the stock might have been at 3,300, but I'm getting the money back. So it's like buying Amazon at 3,100. But then I also protected it at 2,800. So I limit the downside. But since I believe in the growth of this stock, and I wouldn't be surprised if within 2 years Amazon does go through 4,500, I keep that $1,300, and I only paid a relatively small amount for the 2,800. I did the same thing on NVIDIA at 800. I protected it at 400. All the same thing. 2023 options, very long, and then protected at a bit lower. You know, because those, if you go a bit lower on these growth stocks, it's not that expensive. Just in case, knock on wood, the world collapses or something. You know, other than that, though, then I get all the cash and I can invest in dividend stocks.
Actually, you went right away to second strategy of selling puts, but the first strategy is selling covered calls. Now, the covered calls is very simple strategy. Let's see, Nick, if you have your IBM stock, let's say at 150.
Yeah.
And you can sell, for example, but you bought it at 130, it's now 150. Right. You want to protect your gains, and also augment your profit potential. Simply what you can do, let's say you have 100 shares of IBM. You can sell, it's now 150, you can sell, say, 155 call, say, maybe January 22. So you will collect pretty good premium because it's still close to the existing price. You have time that you're selling between now and January 22. And if the stock will go down, say to 140, which is quite possible, right? So you're okay because you will collect definitely more than $10 on selling your call. So you're still okay. You still have the stock. You're not losing anything. In fact, probably your intrinsic value will be over $150 anyway. You collect dividend, whatever is there. And so you enjoy best of both worlds. You're protected to a certain degree. You're generating cash. The only problem I had once, I had covered calls on many stocks. One of them was CIBC, it's Canadian Imperial Bank of Commerce, and it was paying about 6% dividend. But again, because of my greediness, I wanted to augment that with covered calls. And a few times it worked really well. But one time I was exercised a day before the dividend payment. So I didn't lose any money, as you would imagine. I still made good money on that, but I lost my dividend.
You lose your dividend, right?
Yeah.
Yeah,
So,
I guess the only, I mean, I think it's a very popular strategy. It creates extra income for people. You know, I mean, the only issues is two. One, for everything, selling puts especially, you have to watch your margin power because this uses up your margin power, and you want to make sure you have, I don't know, at least maybe 10 or 20% or more padding, because if it moves against you and you've used a lot of margin power, they can actually say, oh, it's time you have to sell your position or sell out of your position, even buying a put that you sold. So,
or deposit more money.
Right. So you have to be careful about your margin power, just if you're doing this. But if you have margin power from dividend stocks or bonds or whatever, then this is a way to generate extra money with Sasha's strategy of selling calls. The worst case scenario for you, Sasha, I guess, is when the stock goes up so much, you make a lot of money on the stock, then you made the money on the call premium, but then you have now faced with a dilemma if it's too quick. Now, do you buy more of the stock to cover the covered call? Or, you know, do you just say, okay, I'll take all my profits and walk? It's a good scenario, but it is the danger. By the way, with the puts, it's the same thing. If I sell an Amazon put for 4,500, and it's happened to me a bunch of times where I said, you know what, I don't think it'll go to more than this. And then it goes higher, and then I made money over that time. And when I have to take a new position, I take profits, but I don't get the full profit as if it expired, you know, at 4,500 in my example. Rather, I have to buy a 5,500 in my example, and maybe within 2 years, and then you make some of the money, but it's not the whole thing. But it's still always free. It's free money in a way.
Peter, you didn't mention one possibility that let's say if you sold covered call, your stock moved higher, and now you are at the dilemma what to do next because stock will be taken away from you unless you will use a strategy of rollover calls. For example, in Nick's situation, let's say IBM moved to 160 and he sold 155 call. So what he can do, he can close 155 call,
Right.
and sell 175 call,
Right.
generating even more money and keeping stock, collecting dividends, and have the best of both worlds. Okay, now we are ready to move to our next segment. Do we have?
Yeah, we have another break, and we'll be back in just a minute.
Okay.
And that was a pretty quick one too, Sasha.
That was absolutely. So now we're ready to move to our next and last segment for today. Let's talk about our recent individual trades and what's on our radar. I didn't do a lot of trades in the last week. Basically, all I was doing, I was adjusting my existing positions. For example, I could, one of my positions is my ultimate protection from the market downturn, as I mentioned several times on the shows, is TZA. TZA, it's a triple bear Russell 2000. And obviously, if the market downturn will probably sooner or later it will happen, but we don't know when. However, what I'm doing to sort of manage this position, I'm selling covered calls from time to time, and so far it works really well because there was no downturn. So all these calls expire horses, and I'm selling next. I'm not selling long calls, of course, on that. I'm selling maybe a month and a half time calls, and then sell next calls. So. With this in mind, I would like to mention that once it expires, I'm selling next call. So sometimes I'm taking profit. Let's see, I would sell long-term calls on Barrick Gold. So when Barrick moved down a little bit, and I have large position on Barrick Gold. So what I'm doing, I'm buying back these calls, and I'm making really good profit on that, which offsets a downturn in prices. Let's see, recently Barrick Gold went from $24 to 22, almost 23, 22 something. So I sold a little bit closer, say July, 24 calls instead of long-term calls. So I will see if they will expire horses, and I will sell probably August or September calls or something like this. So not significant trades. What about you, Peter? Any interesting trades?
Well, it's been a struggle. First of all, the market doesn't know what's happening. It's very kind of choppy now because everybody's afraid of inflation, and I think there's going to be some inflation, but it all depends. Last year, the inflation was 1.4%, so below average. This year, they're talking about 5%, maybe more. I think energy may go through the roof, but people spend less of their money on energy than they used to. So I think there will be some short-term inflation, but in the end, I just want to lock in income. So I struggle, especially when I trimmed one or two things a tiny bit, but I kept everything. But finally, I found something I like. To relate this, first of all, I've always liked the consumer staples because these companies, they're international. They don't pay big dividends, but they're dividend growers. And, so I had a large position in RHS. Now it's even bigger because it was about 7% of my portfolio maybe a year ago. Now it's 9%. And it's the Invesco S&P equally weighted fund. So they have 33 funds, 33 companies, excuse me, and they're all roughly equal, and they do a good job of selection. You're paying 0.5% for the management fee, but I like it. So, I was reluctant to add to that because it's up now. It's paying 2%. When I bought it, it was maybe 2.5%. But finally, I found a company that was interesting, P&G, the old Procter and Gamble. And you know what? Everything depends. If there's massive inflation, a lot of the market will be hurt. But then that's where gold comes in, and that's where it's all balanced. But my fear is, I have a bunch of bonds and other things, and I'm afraid interest rates are heading towards zero in the next 10 years. I bought like midterm bonds, so in 7 to 10 years is like my bonds are going to expire, and what if I'm getting 0.2%? Right now, if I go in the muni market, I can get 0.5% on a safe state bond, give or take. So here's the things I like about P&G. First of all, they have a 2.6% dividend, which kills the dividend, obviously, on a bond. I view it as a bond substitute. I don't expect huge growth out of it, but they've been growing very steadily. They've been growing, if you look at almost any period, they've been growing 3 to 7%. In the last year, about 4 to 7, depending on the year, the period. Like if you look at a quarter, 2 quarters, 3 quarters, you have different rates. But their revenues are growing, their profits are growing. Here's what's interesting, first of all, that I just discovered. They had 170 brands recently. Maybe, I don't know how long but they just finished a restructuring. And now they have 65 brands. So they trimmed a lot of their brands. They sold them off. And I'm assuming that the 65 they kept were their best brands, either their safest brands as cash cows or their growing brands. And their recent growth seems to be much healthier than the last 5 years when it was maybe 3%. So you would think that, and these are all dominant brands, by the way. I mean, things that we all use in our cabinets every day. So with the diversity of 65 brands and a growing dividend, I like it as a bond substitute. And so I put 1.5% of the portfolio in there, and at least got to deploy some cash. And if I didn't say, oh, and by the way, they've increased their dividend for 64 consecutive years and 65 consecutive quarters. So it seems like a nice diversification play. I'll take 2 5/8. Hopefully it'll grow to 5% in 10 or 20 years. I just hold on to it, and I like it.
Nick, any recent trades besides FireEye? What would you?
FireEye. Well, FireEye actually came back, so I'm not too
Yes, somewhat, yes.
mad about FireEye, but I like Peter's picks on P&G because I don't have anything in the consumable area. And what I'm doing is I'm pulling cash out to push into the market because cash just isn't earning anything. It's like dead. And anything that's above 0.9% is gravy. Okay, because that's what I'm sitting on, and I still have more in cash account, and things keep coming into cash, and we're like, horrible asset to hold right now. Okay, so P&G looks good. I mean, I just
and consider RHS too, because it spreads it out. You know, I had nothing in consumer staples, and if I wanted consumer staples, which I personally like, for the long run, then I do maybe consider both.
Yeah, well, I'm going to take a look at that week. This week, I went and I bit the apple. Okay, because the thing is, I'm going like, Apple hasn't moved very much in years, and the thing is, the tech stocks have taken off. I mean, the tech stocks are like in crazy land in terms of what they want for Amazon, what they want for Alphabet. And so I figured, well, give it a shot with Apple. So I put a shot in Apple, and I bought Peter's picks last week. So I don't know what it was, though. It was that pipeline natural gas holding.
But don't you think
AM Holdings or something like that?
Antero Midstream. Yeah, I only put a 1/3% in there, but
I don't have much, but
it has a 9% dividend, and it very well may pay that for all time.
Yeah, and the pipelines get beat up like they're going to kill the Keystone Pipeline. But the thing is, here's the reality: it is a more efficient form of transportation of things like oil and natural gas. And the way I look at it, because remember, anybody who's paying a big dividend, you have to think, why are they doing it? Because it doesn't make any sense. You go out right now, our company can borrow money at 3 1/4. I mean, and we're sitting on, back at my corporation, I'm just messing with my individual, we're sitting on a lot of money at the borrowing rate at 3 1/4. So a company who's paying a 10% dividend, why are they doing it? Just go borrow the money at 3 1/4 and get rid of your stupid shareholders. So
they don't want to do that. That would be burning their shareholders. And a lot of those people,
see, they're allowing, hey, Peter, they're allowing us to participate in a 8% or better dividend. I feel like honored. If somebody said, hey, I got this corporation, I got this anything, it's going to pay you 8 to 10%, with very low risk. And so when you look at Procter & Gamble, 2.5 to 2.8, that's so much better than cash. And seriously, what would sink that ship? I don't know. I mean, because they sell stuff that everybody needs all the time and the brands they need. The only thing I can think of that could be a destruction play is your friends at Amazon coming with generics and saying, buy Amazon toothpaste, buy Amazon,
You know what? I'm not switching. I have a whole medicine chest full of stuff. Like I use, Glide. I use, oil of Olay. I'm not switching. It's like
I know that, but the thing is, other than something dramatic like that happening, what's going to happen to P&G? Nothing.
Only inflation. Only inflation.
But inflation, they just raise their prices.
But inflation's going to hurt everything, and eventually they'll raise their prices. They'll be around.
In fact, inflation might even help them. The stock go up because the inventory is worth more.
It could.
Peter, the inventory is worth more, so they're sitting because they're sitting on a big inventory of their junk. And all of a sudden, their junk is worth more because they didn't do anything. But inflation, all you have to do is reprice Crest. Okay, let's say it's one of their brands, and it's toothpaste at $2. Now it's $3 a tube, and they're sitting on a ton of inventory.
That's why I like consumer staples, because people need them, and they can raise the prices a couple % a year, and you just eke it out. And again, the only thing that could hurt is huge inflation, but. In which case a lot of stocks will be killed, but at least you'll get your money back because you have a duration. So
Right.
sooner or
Well,
later, I
it's
get my
better
money back.
it's better
You
than
mentioned,
putting in a money market at 0.9%.
Right.
Nick, you mentioned
0.9,
interesting.
find me 0.9, please.
I can't. I think that's what it is. I'll have to
You've
go
just
look at it.
mentioned a very interesting possibility about Amazon toothpaste, Amazon t-shirts, Amazon shoes, Amazon everything. Okay, so that reminds me, an old movie in the 90s was A Demolition Man, when things are in the future and he was frozen and then he wakes up in the future and they're taking him to a restaurant. They're coming to a Taco Bell and it's a fantastic restaurant. There's a pianist playing and it's like a 5-star restaurant. And he's quite surprised. Is that a Taco Bell? They tell, yes, there was a restaurant war several years ago, and Taco Bell was a winner. So now all restaurants are Taco Bell. The fast food joints, the posh 5-star restaurants, everything is Taco Bell. So are we going to a world where everything will be Amazon? Who knows?
Well, I mean that's their game plan. Like I said, if anybody wants to worry about anything, worry about Amazon taking over your business. I think they even tried to get into financial services, but I'm not sure. General Electric years ago, and Peter probably remembers this, they got into the insurance business and they got slaughtered because it was like no other business they were familiar with. And they bought First Colony and they got slaughtered. Now they're out of financial services because they figured, well, we really don't know that. See, Amazon, though, I don't know where they're going to move to next in terms of trying to take over. Will they really try to take over consumables? That's
I
very
remember in the 90s, I was on a cruise ship, Sea Goddess 1, and there was a team from General Electric Capital.
Yeah.
At that time, General Electric Capital was contributing 25% of all profits of General Electric. No more, as we know.
Yeah.
But it was a fantastic unit.
Yeah.
And they were bigger than any U.S. bank, by the way.
They had their run up, but my problem every time I look at GE is that one of their big sectors, I don't know if they sold it, was making aircraft engines, which we already have a glut of. And I'm going, if that's your big deal, then, and they sold off a lot of their units. It's been so changed. It's just like FireEye. I liked FireEye, and then the guy sells half the company. And you're going like, what the heck? What are you doing? But Wall Street has bounced back on the FireEye, saying that they got rid of they're in now their high growth, low margin business as opposed to the high margin, low growth business. Now, whether that's a better strategy or not, time will tell. But
time will tell.
Yeah.
Well, in the meantime, we are approaching the end of our today's show. Thank you so much, Peter and Nick, for participating in the show. And we'll see you next Wednesday. Thank you so much. It was Pod TV, Financial Modern Investing. Bye-bye.